Strategies. Hello and welcome to Pro Trader Strategies Market Commentary for Friday, April the 27th. My name's Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Please take a moment to read over this disclaimer as it talks about everything I say in these market commentaries should be construed as general market commentary and not investment advice. The reason why I can't give you investment advice is because I don't know what's in your risk. I don't know why I keep saying that. I don't know your risk parameters. I don't know what's in your portfolios. And therefore, what I'm doing could be counterintuitive to what you are already doing. And please remember that past performance of any trading system or methodology is not necessarily indicative of future results. All right, having all that out of the way, let's get it on with some economic data across the pond. We got French flash GDP coming in at 0.3%, expected to be 0.4%. So a bit of a pullback there. But last month's number was revised up slightly, so that makes that one somewhat of a wash. And then we also got the French preliminary CPI, Consumer Price Index, coming in line with expectations at 0.1%, expected to be 0.1%. Consumer spending out of France came in at 0.1%, expected to be 0.4%, and they did revise last month's number up slightly from 2.4% to 2.5%, but not enough to make up for that deficit we've seen there. Spanish flash CPI coming in at 1.1%, expected to be 1.2%, and Spanish flash GDP, gross domestic product, come in at 0.7%, expected to be 0.7%. Then over here to the United States, we got our own GDP, advanced GDP, quarter over quarter coming in at 2.3%, expected to be 2.0%, so slightly higher than expected, but we are seeing a bit of a pullback from last month's reading that originally came in at 2.6%, came in revised up to 2.9%, so better than expected on both of those, albeit there is a look as if GDP is starting to come off just a little bit and may cause the Fed to rethink raising interest rates. Then we have the advanced GDP price index coming in at 2%, expected to be 2.2%. So we're not really seeing that inflation rally up. And that's about it. Oh, finally, we got University of Michigan Consumer Sentiment revised up to 98.8, originally came in at 98. So a little bit better than expected there as well. So, all in all, it's kind of a tussle between the markets. The markets don't want the Fed to raise rates. We're seeing that happen in the bonds. They're starting to get that bounce that I talked about. But let's talk about the overall markets and go through these step by step. We've got crude oil futures slightly off today by about 31 cents, but for all intents and purposes, it's pretty nondescript what direction it's going to go. Anytime you get these two dojis like this back to back, it's usually a continuation pattern, but I don't think that we've really seen a topping pattern here. So I don't know that that's going to mean that it's going to go down. It could go in either direction, to be quite honest. Then gold futures, trying to make that rally back above that 78 Fibonacci level. It's pushing up against it right now. Yesterday we kind of cut through it finally after bouncing on it for quite a few times. That breakdown, not out of the woods yet. I thought that we were going to see a little bit more continuation, maybe even come down to test that 200-day moving average, but not really in the cards as of right now. Yesterday's Bitcoin rally towards the end of the day really helped out the bulls because it was really starting to look pretty bearish here if we settled down below the 50-day moving average or even the 9-day, which we just kind of kissed. But that rally late in the day helping out Bitcoin for sure. We need to get above that 23 Fibonacci level really to claim a small victory there if you are a bull. Bonds is what I was talking about after the big sell-off. We're starting to see a bit of a bounce. Could be partly due to short covering, but I think more in line is the fact that the market's starting to wonder if the Fed has maybe gone a little too fast and maybe even a little too far on interest rate increases. So the market's trying to maybe signal a little bit of a hint to the FOMC before next week's interest rate move that, hey, you might want to settle down on these interest rate hikes. They aren't expected to move next week, but in June is the next real move that is priced in. But Dow Jones off about 60 some odd ticks right now. And then NASDAQ is off probably more. It definitely is more in percentage terms. It's down over 1% right now, down 77 ticks on the day, about half back on the move yesterday. And again, this is what I was talking about. Trying to get through all of these different levels is going to be very difficult because there's so many different people playing the different Fibonacci levels. That's going to make it much more of a resistance area. You can see that it got through the extension, the 23 extension, but then when it got up to the 23 fib for the 52-week move, you can see that's where it started losing a little bit of steam. It also happens to coincide with the 50-day moving average, which makes that even more difficult to get through. I've been talking about those three things coming in line for quite some time, and you're starting to see that resistance that I've been talking about. Yesterday, the E-mini S&Ps were able to get above their little lines in the sand that all coincide, but now they're having a little bit of trouble getting through that 9-day moving average and finding support on these Fibonacci levels that were going to act as resistance. We kind of cut through those yesterday like butter, but today you can see it's acting as support as well. Onto the 30-minute chart of the mini S&Ps. These are 30-minute candles. Each segment with blue is a day move, and as you can see, this is the big rally we saw yesterday, almost unabated to the upside. Today, coming in after the economic data, people started really worrying. We can see that the market came off there. The VIX, obviously, starting to move a little bit higher as the equities come off. That's generally the mantra. Equities come off, VIX moves higher, bonds move higher, things of that nature. VIX is really a fear indicator, but the bonds will go with those levers and pulleys. All right, on to my earnings trades. All right, with Intel, I only put Intel in my IRA, in my margin account, didn't put that in my IRA, but with Intel, I went in and sold the April, and I tweeted all these out, all four of these out. I basically played all of them to the upside and went out, sold the April Intel that expires today, sold the 50 puts in there for 28 cents, and I was able to buy those back for actually 2 cents this morning. Put that in right away, basically before the open, because I was a little bit concerned about the XOM, which I'll talk about here in a minute. So I covered just about everything, got all my orders in before the open, and tried to get out of these. All right, Amazon. I only played in my margin account and went in and sold the April again that expire tomorrow, and sold the 1,395 puts for $3.10, and I was able to buy those back for 2 cents this morning on this big move to the upside. One point it was up over 100 points, so that got me out free and clear, especially with those puts that are expiring today. They're basically worthless, so I was able to get out of those and move on with my life. All right, don't know why I have two Intels, but one of them that I did miss was Microsoft. So let's look at Microsoft real quick on a daily chart. Microsoft, let's go MSFT, Microsoft. And again, rallied on the overnight session. When this is the overnight, the gray area, this is after the earnings release, came up, rallied up quite nicely. I was short puts in here, so I covered those, put those in before the open as well, and went into the April, sold the 90 puts in there for 35 cents, and was able to buy those back for 2 cents this morning. Now, over in my IRA, I did this as a spread, but I added Microsoft as well, and did the April again, sold the 90 puts, but defined that risk by buying the 86 puts, and I did that spread for 30 cents, just bought back the 90 puts this morning for a penny, left on those long puts, just for crazier things could happen. I doubt it's going to move down another $10 today, but crazier things could happen. So I covered Microsoft in my IRA as well. And finally, let's talk about the XOM debacle I had this morning. As you can see here, it's not looking too good. And if I sold some puts, that's probably not working out too well. And clearly it did not. I went and sold the April in my margin account, sold the 79 puts in there for 32 cents. I had to buy them back for $1.16. So I didn't do Amazon as my normal tranche, did it a little bit less, but made all of my trades about equal in value. So for all intents and purposes, what I lost in this XOM, I made on the Amazon, and then the Microsoft and Intel were the winners for me, but didn't quite make up. Microsoft did not make up for the loss in XOM in my IRA. But talking about XOM, I went in there in my margin account, sold the April 79 puts, like I said, for 32 cents, bought it back for 116. And then in my margin account, I sold the April 77 put spread in there for 26 cents, bought back just the 79 puts for $1.11. So I got out of those a little bit better than in my margin account, but I usually try and cover my IRA first anyway. I'd rather lose money in my margin account than in my IRA, because that's not taxed over there in the IRA, so I don't want to lose money over there. But when I did this trade, you can see on the after the earnings last night and then into today, accelerated into the downside. On the open, we've spiked up. Now, I probably had a chance to catch these for about 70 some odd cents to get out. It still would have been a loser, but I wanted to ride it. Right here's where I decided to get out. We came in and started really moving bearish to the downside. I decided to cover it. That's when I got out. You can probably get out for a little bit better right now than I did even, at least by a few cents anyway, as theta decay is starting to pick up. But I didn't want to risk any more on that trade to the downside, so I got out. And that's about it for today. Friday's webinar, which is today, is going to be on the short calls, so check it out. We're going to show what environment, what strike location increases your probabilities of success dramatically. So check that out. Also, give me a thumbs up or a thumbs down, like or dislike. Give me a comment as well, especially if you give me a dislike. Otherwise, if you don't comment, I'm not going to know what is not working for you. So let me know. All right. Other than that, if you can't take that, take it easy.